Hey guys, what's going on? Your old buddy Tim back with my old buddy Stephen Allen from the mortgage firm. Say hi, Stephen.
Hello.
Say hi, Stephen.
Hi, Stephen.
We are like the worst comedy act ever. It's disgusting. Anyway, we'll get on topic and cut the jokes. Hey, appreciate you joining us. This is the video series we are loosely calling Mortgage 101. Mortgage facts and myths and Ghostbusters or whatever. So the mortgage firm is one of the sponsors on our weekly show. So we thought we would do a series of these short videos because when you're on, we get a lot of questions. So we've already talked about a number of things. Those videos are available. You can go back and take a look at those. Today, I want to talk about the type of mortgage that is best for you because there are a lot of different types of mortgages out there and it can get really confusing.
Yeah, really the main thing I would say is that every mortgage is created different. Every borrower is created different. Okay. It's good to know what you qualify for, and it's good to have a good understanding of what's the difference in the programs. So you will always find a conventional mortgage, which is better known as the ones that are 20% down, most people will think of.
Your standard mortgage.
But a conventional mortgage, they're harder to qualify for. And the reason why is because they do have other qualifications that you have to meet. For instance, they have one of the lowest debt-to-income ratios that can be approved. Most FHA loans will do up to 55% of the max debt-to-income ratio. So that means if you make this much money, you can lend up to 55% of that monthly dollar amount.
Okay.
On conventional, it's not that way. Some cases they're 45, some cases they're 50. So they are a little bit harder to qualify for. And they do require a credit score minimum of 620.
And that's a pretty good credit score.
It is. That's a score that definitely at 620 you're going to see a little bit of a rate adjustment. Where you ideally want to be is 650 and above is going to get you the better pricing. So if you're looking, you'll want to definitely pull your report before you ever go to a lender. Check where you're at. Get a good understanding of what is out there. You know, there are other programs such as your USDA programs. Those also have credit score requirements. FHA is going to be your most liberal method. Okay. They will do the credit scores down in the 500s, and they have different down payment requirements.
So really, there's a lot of factors that come into play.
Absolutely.
You know, the how much money you make, how heavy your debt load is. The down payment, the interest. There's a lot of factors that come into figuring out which is the best kind of mortgage for you.
Exactly.
All right. One thing on the last video, we talked about interest rates. We talked about fixed versus ARMs. Really quickly, let's talk about locking in an interest rate because we get asked that question quite a bit. What exactly does that mean to lock in an interest rate?
So there's two ways to do it when you're in a mortgage application. You can do what's called floating your rate, and that's in essence not locking your rate. So
what does that mean? It's floating with the market?
Floating with the market. Okay. So if it goes up, your rate's going up.
Kind of gambling a little bit.
You 100% are gambling that rate. Then you have the term that's better known as locking your rate. When you lock that rate, that takes that market price for that day, and it gives you that locked rate. And so if that market goes up, you don't have to worry about that increasing rate. You are locked in at what it was that day.
Okay, so when you lock in, though, what else does that commit you to? Anything?
It doesn't mean that you have to pay for it. It doesn't mean that you're signing your life away. It just means that if this mortgage goes through, we are locking in our rate and we're confirming that that is the rate that we will end and close our mortgage out.
What if the rate is lower than what you locked in when it comes time to close?
That's really the gamble that you have to look at. In some cases, if your rate expires, if something happened with the process or just something went haywire and your rate expires, there are opportunities to lock at a lower rate. But for the most part, you're locking at the rate, and that's what you're going to close with.
Gotcha.
The alternative would be floating it.
Okay. So really, if you're not much of a gambler, you want to lock that rate in.
Yes, always recommend locking.
Always recommend locking. You don't have people come in and go, nah, I'm gonna bet the odds here.
All the time.
Do you really?
Yes.
What do you do with those people?
I mean, really, you just have to inform them what it is. But I mean, for the most part, lock your rate.
Lock your rate. There you go. Hey, if you have questions about the best type of mortgage for you and how to lock in a rate, how do they get in touch with you?
Mortgagefirm.com/Huntsville, or you can reach us at 256-705-3476.
He forgot the number on the last video.
I did.
We're gonna tape it up on the wall. So, hey, if I can do anything for you when it comes to real estate, give me a call, 256-679-0704, or look us up on the web at revolved.com. Next time, we are going to talk about discount points. What the heck are those?
What are they?
And who should pay them? Not me.